All right. So the key insight of the extended ISLM model that we will learn in chapter 6 is that the financial system matters. The financial system matters, and so far we've not talked about the financial system, the role of banks, the role of shadow banks like hedge funds, mutual funds, mortgage lenders, and all of those. We've not talked about them. But the key insight, which we now need to extend our ISLM model, is by factoring in the role of the financial system. Yeah. And the financial system matters so much so that the financial crisis can evolve into a macroeconomic crisis, right? So it has a macroeconomic effect, meaning the country as a whole can be impacted if your financial system is in trouble. We will look at the Silicon Valley Bank run example to understand and make this real as to what happened, how, what are the kind of events that led to it, and what ended up happening after the fact. We'll also look at the 2008 global financial crisis as an example to understand and apply what we learned in this video by extending the ISLM model. Yeah, investment, savings, liquidity, money model. We'll also learn the distinction between nominal and real interest rate, which we have so far ignored. We'll also learn about there being potential for many bonds, which many different interest rates, and not just one bond, which is our simplifying assumption so far, that there's one bond with one interest rate, but there could be many bonds with many interest rates. And there's this concept of risk premia that we will learn. And finally, we will apply the ISLM model, all of the things that we've learned in this extended model, factoring in the financial system. Yeah. So let's get into it. So the first one, real interest rate. Real interest rate is different than what we hear in the news. In the news, we typically hear about nominal interest rate, yeah, which is the interest rate expressed in dollar terms for that year, yeah. Um, but real interest rate is more like real goods. Interest rate measured in terms of real goods. For example, yeah, if I were to buy a loaf of bread today, yeah, and I'm interested in knowing what if I gave up that pleasure of buying that loaf of bread this year and waited for a whole year? Will I buy, will I be able to buy more of this same loaf of bread or less? That magnitude is what is called the real interest rate. If I can buy more of this loaf of bread than what I could buy today with my capacity, my real interest rate is positive. But if I can buy less of this loaf of bread after giving up this pleasure today, waiting for a whole year, then I would say my real interest rate is negative. Yeah. But if I can buy the same loaf of bread today and I can buy the same loaf of bread a year from now, I would say my real interest rate is zero because there's no impact. Yeah. So that is real interest rate. In terms of real goods, I don't care if I have to pay $10 for this loaf of bread today and $20 tomorrow, as long as I can buy the same loaf of bread with the capacity I have today and tomorrow. Yeah, and my purchasing power remains, my real interest rate is positive or at least equals zero. That's what I care about. But what we hear in the news is the nominal interest rate, and that is measured in the current year, in the current currency of the country that is quoting it. So, for example, if I hear in the news that says 1 year treasury bills, T bills, currently give you 4.24%. Yeah, what does that mean? Well, that means that if you wait for a year, that's a typo, 1.0424. Yeah. So if you wait for a year, you would then get 1 point, you would get $1.0424. Yeah. That's what this means. It says that, hey, if you wait for a year, you would get interest. You would get 4 cents. Yeah. For every dollar, you get 4 cents for 4 to 4 cents. Yeah, so about 4 cents. Yeah, so that is real interest rate. Yeah, so what that means is that here what's happening is if I waited if I didn't use the dollars that I have and I waited for a year, I would get more dollars. Yeah, and that is nominal interest rate. Does that make sense? I'm able to get more dollars. My PT dollars, let's say I had $1,000 and PT would be 1,000. If I had a $10 bill, I have PT is equal to 10. So after a year of waiting, the next year, I would get 1 plus IT, the nominal interest rate, times PT. Yeah, whatever the dollar is, um, um, times however many dollars I had, times the interest that it has accumulated. So PT becomes 1 plus IT times PT. Yeah, so that is nominal interest rate. But they both need to connect for me, yeah, because I'm interested in loaf of bread. And so the question then is, how many loaves of bread can 1 plus IT times PT dollars buy? Yeah, if my PTE became 1 plus IT times PT dollars in the future, I need to find out this one whole loaf of bread. Now I'm able to buy only like slightly smaller loaf of bread. That's a problem, right? Even though I got more money, I got less bread. So in real terms, I lost money. So that is really important, because if we keep talking about nominal interest rate, but our real ability to consume goods and service, the real interest rate is negative, that's a problem. So in a sense, what we're trying to do is, if you want to find out how many loaves of bread I can buy in the next year, it depends on the price of loaf of bread in the next year. Yeah. So all I need to do is I need to look at the expected price in the year t plus 1, PET plus 1, and I need to divide the dollars that I'll get in a year from now, which is 1 plus IT times PT, divided by PET plus 1. Yeah. So that'll tell me, from the dollars that I have, how many loaves of bread can I buy? So if I did that, now all of a sudden I can find out how much money I would need to buy the loaf of bread, and I can then connect that to the real interest rate. How? So we just found out that these many loaves of bread I can buy. Yeah. If I can buy these many loaves of bread, I can equate that to um, the 1 plus RT. If I equate this to 1 plus RT, I'll get the real interest rate. So nominal interest rate, 1 plus the nominal interest rate times the money that I have, divided by the price that I will pay in the year t plus 1, will connect the real interest rate with the nominal interest rate. Yeah. So if we still didn't understand, let's take this example. Yeah. If you bought a loaf of bread for $10, let's say this is the $10 you had, and you're able to buy that loaf of bread for $10. So I'm going to put $10. And you're getting 1% interest rate. Your nominal interest rate, IT, is 1%. So what happens after a year? Your $10 becomes $11. So this numerator, 1 plus IT times PT, is 11. Yeah, 1 plus 1, 1 plus 1% times 10 gives you 11. So this numerator is 11. But now imagine the loaf of bread that used to cost $10 before, it's now costing $12. So PET plus 1 is 12. So what happens here is that you get negative real rate, because what has happened is your numerator is 11, your denominator is 12. So 1 plus RT is equal to 11 by 12. RT is negative 8.3%. Yeah. So 1 plus RT is equal to 11 by 12. It's minus 8.3%. So you just, in real terms, lost 8.3% of the good that you were able to buy a year ago. So super interesting and important to understand, to calculate in real terms, because this real interest rate is what is going to be used by decision makers, householders, companies, to make a decision on investments. They're not going to look at nominal interest rate, which is what's going to be quoted. They're going to look at the price changes, the inflation impact, and so they're going to look at the real interest rate. Yeah, so super important to distinguish between the two, and let us change our ISLM model to use the real interest rate. That's the one of the big changes that we will do instead of nominal interest rate. Yeah, so this will connect the dots. If we had to if we connect the real interest rate with nominal interest rate, we get this formula that's also given in the textbook. Ex ante is the real interest rate, is based on expected inflation. Yeah, so it's sometimes called ex ante real interest rate because it's before the fact. You don't know what's going to be the expected inflation. Yeah. So 1 minus pi e, or what is going to be the inflation um, in real interest rate. And what is going to be real interest rate if you are writing an expected value, meaning you are that value is not known, but you are anticipating before the fact. We call it ex ante real interest rate. Ex post is the realized interest rate. Yeah, it's like after the fact, you already know what the real interest rate was. We call it ex post. Yeah, but the investment capacity decision, as I said, are made on real interest rate. Yeah, and so we need to extend our ISLM curve. We derived this equation, yeah, so far, but we can now add to it the definition of inflation, which is change in price level. So expected, let's say for the same loaf of bread, expected price at t plus 1 minus price at time t divided by price at time t. So that is inflation. How much has the price increased relative to what it was before? So if we substitute this ratio here that we have from this equation, we can rearrange and get to the same to this equation here. 1 plus RT is equal to 1 plus IT divided by 1 plus pi TE plus 1. Yeah, expected inflation is now factored in. So in a sense, we are substituting this equation in here in what we just derived together. Yeah, this can be approximated to real interest rate is equal to nominal interest rate minus inflation expected inflation here. So that as long as these changes are less than 10%, then this approximation holds. But if the real interest rate and the nominal interest rate are greater than 10%, then this approximation doesn't hold. So this equation is same as this equation. So that's why we say it's approximated. Sometimes it can be simplified to say RT equals, not approximate, equals IT minus pi t. Typically they assume these rates change less than 10%. But now we are able to connect real interest rate with nominal interest rate and inflation. So in expectation of inflation. So now all of a sudden we can enhance our ISLM model to factor in real interest rate and expected inflation. Yeah, because those are both important factors. Because that is what governs what the real interest rate would be. Yeah. So historically, let's look at like what has been the nominal rate, interest rate, and real interest rate. And we notice that the nominal rate that's in the news is much higher, the real interest rate is much lower. Typically, you would see with that equation, real is equal to nominal minus inflation. Yeah, so the difference is the inflation component. And when we see negative real interest rate, that is an interesting part. Yeah, what that means is that it's better to be investing, because your money, if you kept in the bank, loses value when you have negative real interest rate in this period. Yeah, so negative real interest rate, you're losing your purchasing power. Yeah, especially if you have inflation that's positive, you would see that a nominal interest rate of 1% and inflation of 3% gives you a real rate of minus 2%. Yeah, so it's probably better for you to be investing rather than keeping your money because it's losing value. Yeah, so super important um, to understand when your real interest rate's negative, what's happening to your purchasing power, yeah, of the money that's lying around. And the second big part that we need to extend our ISLM model is with this risk premia X, yeah. And if we notice, the 10-year government bond um, typically has a lower interest rate compared to even the AAA corporate bonds. What that means is that United States government is considered super safe, yeah. And so that means that the difference between them, between the AAA, the highest rated corporate bonds, and government is always, in this case, positive, meaning a given company can go bankrupt, but the entire country, in this case, United States, going bankrupt is low. So the difference is the risk premium. And we see that if there's slightly lower rated corporate bonds, then you see the risk premium even higher. So in the depths of 2008-9 recession, the government was able to borrow at a much lower rate, but look at what the corporate with lower ratings were able to borrow. These are the ratings given by rating agencies. And so that's a huge drop. So even when we assume real interest rate, we would want to realize that different people on the ground might have different experiences in ability to borrow. Yeah. So different types of companies, different types of bonds will have different risk premium associated with it. In a sense, the risk premium is the extra in return that the investor expects from the risky assets that they hold. I might just be happy holding the government bond. Why do I have to take all of this risk? Well, I take the risk because I'll get higher returns. Yeah. So that is what the risk premium is, the extra return that the investor expects. Yeah. And primarily they expect that extra return because there's a probability of a default, that this company may not even pay back the money. Yeah. And also it depends on the investor who's willing to buy or not buy. If they are risk averse, they would expect much higher interest rate. Yeah. So who's the buyer and what is being sold? Both of them have a different combination impact on the risk aversion of the buyer and the risk premium of what is being offered. Yeah. So super important to understand this, because with this, what happens is if we assume the probability of default is P, we know that with I being the nominal interest on the risk-free asset, let's say the 10-year government bond yield, then we have 1 plus I plus X, the risk premium, is what is expected when there is no default. When there is no default, probability P is probability of default. So no default is 1 minus P. If there's no default, then I expect you to pay me the nominal base rate that I expect, let's say the United States government to give me plus the delta, yeah, which is this risk premium, yeah. And that is what I expect you to give me, because the weighted average is I don't see a default, I make this money, but if there is a default, I make zero money. Yeah. So with this equation, we can now factor and get the value of risk premium X, which is 1 plus I times P divided by 1 minus P, the probability of default. So if you have your probability of default, and if you know the government bond yield that's risk free, then you can calculate the risk premium that you expect. Also, you can find out from the real bond if you want to find out, if you don't know the probability of default, but you want to find that out, look up the actual bond yield of a BAA rated bond. Subtract from it, and subtract from it what you expect the government bond yields to be. All of a sudden, you can derive. You already know the I. You already know the extra risk premium that they are going over the government bond yields. You can find out the probability of default. So you can work that out backwards as well if you knew some of these factors. Yeah, so it's super important to understand why these different types of bond offerings have different risks associated with them. Yeah, and financial intermediaries have a huge role to play, because these are the entities that provide you all of these bonds, these different instruments that you can buy, and that constitutes financial intermediaries constitutes of the banks and the non-banks. Yeah, non-banks are the shadow banks because they are in the shadows of the bank, so they're non-banks. They're mortgage companies, money market funds, hedge funds. All of these are part of the non-banks. So these are part of financial intermediaries. They are the ones that specialize in the borrower characteristic, like who is borrowing the money, what is their risk appetite, what is their credit worthiness. They're really deep into making sure that who they lend their money is going to be able to pay the money back. Yeah. And so what happens is typically a bank's balance sheet looks like this. Let's say it has assets of 100. It has liabilities of 80 and capital of 20. Let's say the bank was started and the shareholders came up with the capital and they put in $20, and then they raised deposits from depositors and they got $80. So together, 80 plus 20, assets equals liability plus equity or capital, in this case 80 plus 20, so 100, both sides of the balance sheets match up. So they take deposits, which are banks liabilities coming in, and what do? they loan it out, and they the loans that they give are banks' assets, because these loan people who are taking loans from that bank are paying back interest, and that's where they're making the money. They are paying their depositors some interest, but they're getting much more from the loans that they are dispersing, so they make profit, and that accumulates profits in the capital that the bank accumulates. Yeah. So capital ratio is a ratio of um, capital 20 divided by assets. So at any point, this ratio is super important, because if the liabilities are larger than the assets, then the bank becomes insolvent. Yeah, because you cannot meet all of your liabilities, and there is a chance of being bankrupt if you can't figure it out. Yeah. So capital ratio is super important. The opposite of it is the leverage ratio. It's just what is the assets divided by the capital. Yeah. For every dollar that is put in by the shareholder, what is it leveraged to? So 1:5. So 5 times. Yeah. And so higher leverage is closely watched as ratio as well. Capital adequacy ratio is also closely watched. So super important, because remember, these depositors can come in any day at your doorstep as a bank and be like, hey, give me my money back. These loans are given for years. Someone just took the money and paid it to the car company which they bought this car, or the machine, or the factory. They're not going to give you the loan because you want the loan, right? So these assets, these loans are long-term loans. So there is a liquidity mismatch. Yeah. The liabilities are liquid. The assets are illiquid of the bank. And so the difference between them is the maturity mismatch, which is, if you cannot serve your depositors in time for when your money is going to come back from your assets, that's a problem, because then the bank would have to sell all of the assets that it has to some other bank at a fire sale. And so then, and when that happens, the bank starts losing money and the capital becomes lower and lower. And so the bank has only two options: increase more depositors, or raise more capital through selling shares or some other way. Otherwise, the bank becomes more and more in trouble. Yeah. And that leads to the bank run, which we will see with the Silicon Valley Bank example. Yeah. So what happens here is that the case with the Silicon Valley Bank is super interesting, because this is connected. Yeah, we just learned about fire sale, bank runs. Yeah, and there's a huge, if there's if you cannot serve your depositors in time for your assets, then there's a problem, and it's exactly what happened with the Silicon Valley Bank. So the context about the Silicon Valley Bank is this: it has majority of its client. It had majority of its client in tech companies, venture funded companies specifically, and these funds, these ventures companies raise a lot of money, and so they pumped the money into the Silicon Valley Bank quite a bit when they were able to. The startups were able to raise a lot of money, and so then when they raised all of this money, they pumped it into Silicon Valley Bank, and they kept raising more and more money from venture by Series A, B, C, and D. Yeah, so they never really needed the money in the bank. But what happened is around 2022, a lot of in 2022 and 23, when um, when the funding dried up. Yeah, when the funding dried up for the Silicon Valley Bank, primarily because these venture funds were not able to raise more funds, primarily because the interest rates had started going up. When the interest rate starts to go up, what happens suddenly is that people want cash flows more quickly, and cash now is more important than cash into the future. Cash into the future is same as cash now if the interest rates are low, so people are betting big on these companies. But when interest rate starts to rise, then cash now is more important. And so these big tech companies, these venture-backed companies in tech, which didn't really have a lot of cash flows and were not able to raise money, what happened is they started now banking on the bank deposit that they had to pay their employees money. And so what happened is, when they started asking the bank for the money, the bank had to, even though it had amassed a lot of this money, it had invested all of it into long-term government bonds. Yeah. So remember, assets were investments in long-term government bonds. But these tech companies all of a sudden together started coming saying, hey, the funding has dried up, and so we need to pay our employees, and we gave you all of this money, so give us the money. And so because it had invested heavily in these long-term bonds, it couldn't, if it waited until maturity, they would make a lot more money. But the depositors were like, hey, give me my money. And so when they came in, they had to sell a lot of those bonds at a loss. And when that happened, the Moody's investor um, services team informed the Silicon Valley Bank that, hey, they have a lot of unrealized losses in their banks. And so they're going to downgrade the bank. So the Silicon Valley Bank executives even flew down to New York City and convinced them, but the downgrade still happened. And even though they raised the money, so on March 8th, they raised money and they also signaled that they're going to shore up more capital through stock sale. Next day, $42 billion were withdrawn from the bank. And so that almost had a bank run because now they had to keep selling all of the money that they had um, within a matter of days, within 2 days. And this got amplified big time by social media and LinkedIn, Facebook. You start to see all of these big venture capitalists writing to their, um, CEOs of the companies in which they have the money invested in, saying, hey, take the money out of Silicon Valley Bank. And so all of a sudden, within a day, $42 billion, largest bank run in the history, $42 billion had to be taken out. And so imagine you are this bank, you've invested in this long tenured government bonds, but your depositors are not waiting for you. And so what do? You keep selling at a fire sale. And so um, the stock price plummeted, yeah, big time. And then the next day, the US regulator shut down Silicon Valley Bank. And that had a similar impact on another bank, the Federal Bank, as well, and another bank as well, UBS and Credit Suisse. Credit Suisse had this drop in share price as well. So you start to see that um, this is a contagion effect. Yeah, one bank, if it closes down, imagine what would have happened if the Federal Reserve didn't step in at this point and guarantee almost that all of the money will be protected, even beyond the $250,000. Then what would happen to all of these venture-backed companies? What about all of the employees? What about the startup ecosystem? Yeah. And so that is a huge impact to innovation. And so the government came in, made the company whole. All of the money was within a matter of days. There was liquidation, and then a lot of events are listed here. But in a sense, the bank was made whole, and the second bank was also made whole, and so on and so forth. The Federal Reserve stepped in big time and plugged this hole and reduced and um, removed this contagion of the bank run. Because if this happens, then multiple banks, which because these all banks they borrow from each other, and so if one bank is shut down, then what happens to all of the borrowings of the other bank, and so on and so forth. Yeah, so that is huge for this to be working correctly. So the financial system has a huge impact on the macroeconomic situation. And what happened here, and so what we saw here is that the risk premium increasing, yeah, or the expected inflation increases reduces the demand. When that demand reduction happens, we see the investment savings curves go shifts to the left, production drops, investments drop, and overall income eventually drops, consumption eventually drops further, and so on, what we've seen in the previous chapters. Yeah. So in a sense, if you were to extend the ISLM model, what we will do is, first thing, we would replace the nominal interest rate with real interest rate. which is here. Yeah. And the second piece we realize is that there's a zero bound. Yeah. At zero lower bound, the real interest rate cannot be more negative than the inflation value if inflation is positive. Yeah. So those are the two impacting factors here, which is using the real interest rate. And coming back to the global financial crisis, we can apply this. We can apply all of what we've learned here, which is replacing this by real interest rate, and see what happens. Yeah, the housing prices started to decline, and this is the Schiller index for how they've calculated this house prices on an aggregate basis. And so when the global financial crisis happened, the way it started was quite interesting. Most of these banks, because there was such a huge good time after 2000, we remember we just went through the 2000 crisis, and then the government stepped in, the monetary reserve stepped in, zero interest rate. And so from 2000 onwards to 2006, this was a huge rise in housing price, like went from 100 index to all the way 2.2. Yeah. So banks were highly leveraged and continues to get highly leveraged, and they were providing these ninja loans. What is ninja? No income, no job, and no asset loans. Meaning these people had no income, no job, and no assets, but still were given a loan. And these were all good times because lending was at lower rates and housing prices never went down. So there was an assumption that they'll never go down up until 2006. Even during the 2000 recession, we didn't see the housing price goes down. So up until here, there was no assumption that the housing price could ever go down. But that changed. Yeah. And when it slightly reduced, some of these ninja loans with people who just couldn't afford those houses, they went under. Yeah. And so when they went under, it was almost like, oh my God situation. Why? Because there was these complex instruments used. What was the first one? The SIVs, structured investment vehicles. So this is what the banks use to provide these loans and bypass the capital requirements that the regulation had. And the way they did that also um, made it look like the balance sheet of the banks was in a much better shape than what it actually was. And on top of that, there was securitization, which is a way to bundle up all of these loans to diversify risk. Imagine you had the Silicon Valley Bank with just tech concentration. What if they could have loans bundled up with something in the East Coast or something in Texas? All of a sudden, you have securitization that helps you diversify the risk. And when you have diversified risk, you have more and more people willing to invest money. So you get more and more people willing to invest money into this security. And these vehicles that made the bankers take risks because the risk was not shown on their balance sheet. And so then what happens is more and more investors are available, and all of a sudden the risk was not, the incentives were to make more money, but the risk was not pulling them down. And so when those first claims happen, yeah, on these issues, there are also these different levels of securities that were introduced. So SIVs was introduced. Mortgage-based securitization was done for diversification, and also senior securities had first claims, but there was this junior securities also created, which are called collateral debt obligations, which are junior securities. So different types and different levels of securities were created, which made valuing these securities harder and harder. So uh, when all of these investors who were funding this through wholesale funding, which are in a sense short-term debt, when some of these prices, housing prices decline, and some of these ninja loan folks were not able to pay their loan, or they were subprime mortgages, it was very hard to assess the value of these MBSs, yeah, mortgage-based securities, and to really find out which one was senior, which one would get the money. And so confidence started getting lost in terms of whether how much is the loss here. And so what happened is huge reduction in consumer confidence happened because it was not clear how much is the loss that we are um anticipating. And so that had a huge impact here. And so the Federal Reserve saw this coming, the fiscal folks in the executive branch saw this coming, and so they acted very quickly. The Federal Reserve did FDIC increase from 100,000, which was the case before this scenario of 2008, to 250,000 coverage. In a sense, it's an insurance scheme that protects the depositors. So they went and did that. They provided lots of liquidity facilities and increased the assets that can be used as collateral. They also increased relief programs to shore up and clean up all of these complex MBSs, CDOs, and SIVs, yeah, from the bank and infuse capital. So there was a lot of financial measures taken. um, Monetary federal funds rate was reduced all the way down to zero by December '08. Lots of unconventional monetary policy with quantitative easing, buying of different types of assets was done by the Fed. And also, fiscal policy was implemented with the American Recovery and Reinvestment Act, which had another $780 billion in measures to reduce taxes and increase spending. So you could imagine the US budget deficit increased from 1.7% GDP in 2007 to 9% in 2010. And so if none of these things were done, the IS curve would have shifted from IS to IS dash, meaning point A in equilibrium would have gone to point B, which is somewhere here. But because of all of these financial and fiscal policies, the IS dash curve shifted back to IS double dash. So it went here. Um, so it would have been here. But then the monetary policy also reduced the nominal interest rate all the way down to zero. Yeah. And so that led to further increase in output. But there was all of these massive measures were still not enough. But there was still a recession that got caused and the reduction in output that happened. So now we understand why financial systems are huge, super important. And if they go out of whack, then there's a problem. Yeah. Are they too big to fail? Probably they are. And there are also incentives now for precedents set with the Silicon Valley Bank, the Federal Bank. Hey, if you fail, if you take risk and if there's an issue, Federal Reserve will come in and bail you out, make you whole. Well, so if you remember one thing from this entire chapter, the financial system matters a lot, and it can have a huge impact on the macroeconomy as a whole. On this Christmas Eve, there's this really good movie, It's a Wonderful Life. And I have put a link here where this person is able to convince everyone to not do a bank run. And that's a pretty interesting 4-minute video if you want to watch. And this movie is typically played every year. That's what the author tells in the book around this time. So this is a positive scenario in which the bank run was avoided. But the authors also shared another book, Mary Poppins, another Mary Poppins movie, where if you want to see how the bank run happens, there's another movie to also check out. Yeah. So check out this link. It's here, or you can just put it on YouTube. It's a Wonderful Life bank run, and you will see this interesting fact as to how bank runs happen and how it can be avoided by this creative um, person and how they did it. Yeah, I'll see you all in the next video. Thanks.